Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we're dedicated to bringing you the absolute best trading education to help you take your trading to the next level. In today's podcast, we'll be talking about which time frame should you use when charting. In order to consistently make money in the markets, traders need to learn how to identify underlying trend and trade around it accordingly. Common cliches such as trade with the trend, don't fight the tape, and the trend is your friend. But how long does a trend last? When should you get in or get out of a trade? What exactly does it mean to be a short-term trader? Trends are classified as primary, intermediate, and short-term. However, markets exist in several time frames simultaneously. As such, there can be conflicting trends depending on the time frame being considered. It is not out of the ordinary for a currency to be in a primary uptrend while being stuck in an intermediate or short-term downtrend or downward movement. Typically, the beginning or novice traders lock in a specific time frame, usually ignore the more powerful primary trend. Alternatively, traders may be trading the primary trend or underestimating the importance of refining the entries in an ideal shorter term time frame. So, what time frames should you be tracking? A general rule of thumb is that the longer the time frame, the more reliable the signals given. As you drill down in time frames, the charts become more polluted with false moves and noise. Ideally, traders should use a longer term time frame to identify the primary trend of whatever they're trading. Once the underlying trend is defined, traders can use their preferred time frame to define the intermediate and the faster time frame to define the shorter term trend. A swing trader who focuses on daily charts for decisions could use a weekly charts to define the primary trend and then the 60-minute charts or the 1 hour time frame to define the shorter term trend. A day trader could trade off the 15-minute charts, would use the 60-minute charts to define the primary trend, and a 5-minute chart or even a 1-minute chart to define the shorter term trend. A long-term position trader could focus on weekly charts while using monthly charts to identify or define the primary trend and daily charts to refine entries and exits. The selection of what group of time frames to use is unique to each individual trader. Ideally, traders will choose the main time frame they're interested in and then choose a time frame above and below it to complement the main time frame. The bottom line is that by taking the time to analyze multiple time frames, traders can greatly increase their odds for a successful trade. Reviewing long-term charts can help traders to confirm their hypothesis, but more importantly, it can also warn traders of when the separate time frames are diverging. By using narrow time frames, traders can also greatly improve their entries and exits. Ultimately, the combination of multiple time frames allows traders to better understand the trend of what they're trading and instill confidence in their decisions. Anyway guys, that's it for me from today's podcast on what time frame should you use when charting. Do remember to subscribe to our podcast, as here at IronFX, we're dedicated to bringing you the very best trading education to take your trading to the next level. Till then, stay safe and trade safe.